Funding is an obviously critical step. You've got to find funding for your business. You have to determine if it's the right type of funding. And the adage that beggars can't be choosers is correct, but you really want to be selective in how you go about funding your business. So we'll talk about personal money, debts, loans and credit cards, grants, crowdfunding, investors, sponsors, and other ways. Look no further than your bank account to fund your startup. The pro is you maintain complete operational and financial control of this. There's no equity that you've given away. There's no stakeholders you need to answer to, and you can get started right away. The cons of this then, of course, are you're limited by potential funds, and if you don't have many, then this may not be an option for you. If you've taken out personal loans, used your house as equity, if the business fails, you may face a lot of personal debt. And I had a family member do this, took out another loan on their house to fund their business, and then closed the business, leaving them with 2 mortgages on a house. Interesting story with personal money is the idea of the TRX resistance bands. Randy Hetrick was a Navy SEAL. He was working out in the middle of nowhere and started developing a system, went to business school, used $50,000 of his own money to start the first iteration of the business. While he was also in business school, had gone to trade shows and things like that to drum up some business, and he got an endorsement through Drew Brees, who plays for the NFL. This idea goes back to what we talked about in marketing and connecting to some important people. This endorsement by Drew Brees then helped launch the company, and you can see, and in 2018 they did $50 million worth of business, all started from a Navy SEAL in deployment solving a problem. The lending process is inherently a tough one, but it's also a system that has been a catalyst for many, many businesses to succeed. Before you land a loan, you need to understand how to maximize the odds of success, and the lending process is inherently a tough one. So companies starting out don't get loans. There is no track record yet. They don't have any collateral. There's no goods to sell. There's no track record. And the idea of collateral is if you fail to pay back the loan, what will the bank take in return for that? So a home mortgage is based on collateral. If you fail to pay the mortgage, the bank then will own your home, then can sell the home and pull out the money that they invested, helped you invest to buy the house. If you have a business that's just starting out, there is no collateral. There is no product. There's nothing to sell. There's no track record, so it's not likely to happen. If you have been in business for a little while, it's a lot easier to get a loan. You don't have to give up equity, proceeds, or control to get funded. You must pay interest on the loan, and if you don't keep up with the loan payments, you could ensure yourself at a tough spot with the bank, but it is possible to happen because now you have some sort of tax record, there's a profit and loss statement, and there's a trajectory that says this business is going in the right direction. So they can estimate if we've done this many sales for the first 6 months of the year, possibly we could see that replicate next 6 months. That's more likely to ensure something with a loan. The Small Business Administration is an important part of our ecosystem in the United States. And they don't actually give loans, but they help guarantee loans. And there's some of the steps that happen. So you must be a for-profit business. We've talked about nonprofits, so they don't work with those. Do business in the U.S., have some of your own money invested as equity, and then you can see if you did not get a loan from a traditional bank, they're willing to then sit down with you and figure out how they can help. And the word small is relative. You can see here between $500 and $5.5 million is their loans. Small business means under $750,000 operating budget with under 500 employees. So a lot of businesses fall under that umbrella of small. Should you get an SBA loan, they are generally at about 5.5% interest. So you can see here with a $10,000 loan paid back over 24 months, you would pay only $583 to get that $10,000. And if you've taken an economics course, our entire country runs on debt. It's fairly scary. Another option with debt is the idea of credit cards. Generally a terrible idea, but sometimes it is the only option. Interest rates vary based on your personal credit score, but most credit cards are at about 18%. So what does that look like in a $10,000 loan? So you would pay about $500 a month over 2 years. Roughly, you would have paid about $2,000 to get that $10,000 loan out. So you can see it's a pretty expensive option. There are one-year interest-free credit cards available, but only if you have a great credit score. So what is a credit score? It is a number that's been assigned to you without you ever agreeing to it, where companies share information on your buying habits and they ultimately represent your creditworthiness of an individual. How likely are you to pay the loan back? And the three big companies that monitor this are Equifax, Experian, and TransUnion. The federal government has set up annualcreditreport.com where you can log in and see what your credit score is from each of those three companies. This is the only official site offered to U.S. citizens through the U.S. government, the Consumer Financial Protection Bureau. If you've not done this, I suggest doing this and going to see if you have a credit score and what it is. Numbers vary, and I don't want to get into speculating what your credit scores might be at all, but this is all going on behind the scenes without you ever agreeing that you should have a credit score. These companies have been monitoring your purchasing habits. So I suggest taking a moment and going to see what that looks like.